Tim Sage, Nathan Tipsworth, and Stephen Ball to explain the recent accounting standard update on debt issuance costs. On April 7th of this year, the FASB issued a new accounting standard update on debt issuance costs to simplify the presentation. According to the board, unnecessary complexity was being created by differing requirements of debt issuance costs on the balance sheet presentation to debt discounts. So the new standard will thereby more closely align U.S. GAAP with related IFR standards for comparability purposes. This alignment will be accomplished by requiring that debt issuance costs associated with a recognized debt liability be recorded as a direct deduction from the debt liability's carrying amount. Previously, these costs were recorded as an asset on the balance sheet, which were then amortized through interest expense using the effective interest method. But these costs lack future economic benefit and thereby cannot be defined as an asset. Thus, under the new standard, debt issuance costs will be recorded in a similar fashion to debt discounts. The ASU will be effective for public business entities for fiscal years beginning after December 15 of this year, and will also allow for early adoption. Additionally, the ASU will require retrospective application to prior period financial statements, including the applicable disclosure for change in accounting principle. Overall, the scope of this particular ASU is limited in purpose and does not change prior recognition and measurement methods as mandated by other forms of accounting guidance, such as the requirement to record debt issuance costs separately from debt discount, or debt issuance costs separately from debt discounts. Yeah. And so now Tim will illustrate how the debt issuance cost standard is part of FASB's simplification initiative.
Okay, so the board is issuing this update as part of the simplification initiative. The objective of the initiative is to identify, evaluate, and improve on areas of GAAP for which complexities and costs can be reduced while maintaining and even improving information that is useful to users of the financial statements. This update is now in compliance with concept statement number 6, which states that debt issuance costs are similar to a debt discount. Therefore, they do reduce the proceeds of borrowing and thus increase the effective interest rate. Also, statement number 6 states that debt issuance costs are not an asset because they provide no future economic benefit. The board does anticipate, as a result of these updates, that entities should not incur any significant costs during the transition. They also do anticipate that as a result of the updates, the complexities will be reduced because there will be a consistent presentation of debt issuance costs along with debt discounts and premiums. One thing that arose during this update was the inconsistent manner in which debt issuance costs were presented on financial statements. This is specifically in reference to costs incurred before the debt liability is reported. The example that the board provided was costs associated with an undrawn line of credit. They did acknowledge that these circumstances do exist. However, the board did not consider providing any guidance in these situations. The reason for that is they observed in practice entities would defer these costs, and then once the proceeds are received, they would count that against them, so that is in accordance with the update. Also, the board concluded that this guidance, the guidance in this update is specifically clarifying whether or not debt issuance costs are the debtor's assets. We believe they have definitely accomplished this in this update. And now Nathan's going to talk more in detail about the old standard compared to the new standard.
All right, guys, so for you, I have a bit of a financial lesson. So our example that we have based up here is it's kind of based on KPMG's document responding to this update. So what we have here is a non-interest-bearing note, $1 million face value, and it's discounted at a rate of 5%. So what we have in the carrying value for the issuance is $907,030. This is just the simple discounted back, the $1 million, 5% discounted back for the 2 years. Nothing really special about it. The expense, therefore, is the carrying value in the issuance period times the 5%, and the discount amortizes the same amount, and the carrying value is then adjusted and continued on for the second year. So that's what's currently happening in the old standard that is about to be adjusted in the end of this year for fiscal year 2016. So what this journal entry would look like for this process is a debit to the issuance cost, which currently is classified as an asset, of $25,000, which is the issuance costs that are expected to be incurred for this example, and the credit is to cash. And the effective interest rate is just a simple 5%, which is just simply the discount rate. Next slide, please. So what's going to be happening under the new method is we're going to take the carrying value from the previous method and then deduct the issuance cost of $25,000, similar to how the discount is deducted for the carrying value of the bond. So as you'll see, before it was $907,030, now it's $882,030. So now we do the same process over again. However, because of the decrease in carrying value and therefore the increase in the amount that we need to get back to for the face value of the bond at the end of year 2, the effective interest rate now becomes 6.5%. So in effect, they're expensing more annually in the actual interest expense component calculated here. However, because of the issuance costs and how they were allocated before, it actually evens out to be identically the same thing when you do all of the math out. So as we see here, the expense is just a little bit higher. It's around $10,000, $11,000 or so in each year. However, now the that was supposed to be a different journal entry. The new debit and credit for the new method is now a debit to a contra bonds payable account that is similar to the discount, and the credit is still the cash. So this is the comparison between the total expenses. As you'll see here, $57,000 for the new method minus the $45,000 for the old method, and the same process for year 2. Add those up together, you get the issuance cost total, which is represented or equals out to the original issuance costs that were simply amortized, typically at around $12,500 a year if they were just splitting it in two for a 2-year bond. Now I'll pass it over to Stephen, who will talk about the private company council board that was responding to these changes.
So as you can imagine, there has been negative feedback regarding the new standard, specifically coming from private companies. As he said, the Private Company Council, which is a 9-member council representing private companies in the industry. So 2 of the grievances that they have are they believe the face value and carrying value of debt are crucial to a private company's financial statements, and so to have assets taken off the books and also their carrying value lowered is going to hurt them in the eyes of an investor. And secondly, they think it's going to confuse external users of financial statements, specifically private, because they believe when they see the debt with the issuance costs taken off that debt, it's going to not look as good, and also they don't understand why issuance costs are going to be taken off. So I'm going to go into an example specifically about an investor situation for a private company. So let's talk about a private company who is trying to receive funding, and they have an investor looking at their financial statements, and they see that their asset to equity ratio has been lowered because they lost that asset, and they also saw the carrying value of their debt has been lowered. So they're going to say, I don't like this company as much because they might not be as trustworthy as they were before. So the Private Company Council has issued 2 alternatives to the current standard that's going to be implemented. One is to retain current GAAP, and what they're going to do, they want, of course, to keep those assets on the books to make them look better. And 2 is to use debt issuance costs as an expense, which of course would lower taxable income and help them in the long term as well. Next slide. So the board, the FASB board did respond to Private Company Council, and what they said was the goal of this new standard was meant to simplify the issue. So for them to have private versus public companies have different standards when issuing debt would only confuse external users even more. So it just goes pretty much opposite of what they're meant to do in this new standard. And secondly, financial statements and the GAAP is supposed to accurately represent what a company has. So for them to, we believe that the new standard does accurately represent a private company better than the older one. And so for external users, we need to give them the best possible financial statements that are available. And so in conclusion, we do agree that the board is correct regarding the new standard, just because it gives a better representation of the financial statements. I'm going to pass it off to Nathan, and he's going to talk about our conclusion.
All right, so as Stephen has mentioned, we believe that this new update accurately represents what GAAP is all about. It's about consistency, it's about comparability, it's about simplicity for companies, private and public. And so we agree with the majority of the firms and businesses that issued comment letters to this, this update, and that this update will indeed improve GAAP for the better, and will increase the comparability within organizations in an industry, as well as consistency within GAAP, as well as IFRS, and improve the convergence method and effort that is being made by both the FASB and the IFRS. So I'd like to now open up to any questions that anybody would have.
My first thought was, simplifying it from a private company, really more along the lines of private versus public company. Public companies are going to have a lot more resources internally, typically. What's your opinion of private companies that feel a little violated or impeded by this, that may try to recharacterize costs as non-debt costs and just try to expense them anyway? Private companies are typically measured on an EBITDA basis, not necessarily a GAAP net income basis. So, does this standard, I'm assuming it still characterizes how debt costs are defined. What's your thoughts if private companies may try to go another route and just say, really, these are period costs, and we're just going to expense them and not deal with amortizing this contra liability at all?
I think as a group we kind of decided that debt issuance costs are part of a loan essentially, and so for a private company to say that they are just going to be expensed, in our opinion, they are connected. To get a loan and rather to issue bonds, you're going to incur expenses, and so in our opinion, matching expenses or matching, it does connect to the loan. So we agree. Again, that the private company should. It might hurt them, yes, and it might make them look a little worse. But again, it's supposed to faithfully represent a company, and so with that said, I think we're just fine with the new standard as it is.
And I think what you'll find is that in a lot of the private companies, the debt issuance costs when they do enter into